Hi,
Welcome to another episode of Money Wisdom.
I'm Rolf Dobelli, author of The Art of Thinking Clearly, which explains thinking errors. I'm here to talk about induction. A farmer starts generously feeding a goose. At first, the shy animal is hesitant, wondering, what's going on? Why is he feeding me? This continues for a few more weeks until, eventually, the goose's skepticism gives way. After a few months, the goose is sure that the farmer has its best interest at heart. Each additional day of being fed further convinces the goose of the man's benevolence. That's why the goose is amazed when the man takes out an axe and slaughters it. The goose got cooked because he fell victim to inductive thinking, the inclination to draw universal certainties from individual observations. However, geese aren't the only ones who are susceptible to induction. An investor buys a mutual fund. The net asset value of the fund rockets. At first he's wary. Probably a bubble, he suspects. As the fund's NAV continues to rise for months, his apprehension turns into excitement. The market may never come down, especially since every day this is the case. After half a year, he invests his life savings in it, turning a blind eye to the huge cluster risk. Later, he'll pay for his foolish investment. He has fallen into the grip of induction. Induction constantly tricks us into believing that the patterns of the past will repeat in the future. I had a friend who was a base jumper. He jumped off cliffs and buildings, pulling his parachute's ripcord only at the last minute. One day I mentioned how risky his chosen sport is. He replied quite matter-of-factly, "I have more than 1,000 jumps under my belt and nothing has ever happened to me." This statement seemed convincing to him. 2 months later, he was dead. He was killed jumping from a particularly dangerous cliff in South Africa. This single event eradicated a theory he'd confirmed by induction 1,000 times over. Inductive thinking can have devastating results, yet we can't do without it. We trust that when we board a plane, aerodynamic laws will still be valid. We expect that our hearts will still be beating tomorrow. Without this level of confidence, we couldn't function. But remember, certainties are always provisional. Induction seduces investors, leading them to such conclusions as, "My low-rated junk bond portfolio is giving me steady high returns." Well, that's fine as long as it lasts, but it comes to an abrupt end when the bonds default and shatter the previous illusions of safety. So, how can investors avoid the problem of induction? Number one, never assume that history repeats itself in the stock market in regards to the performance of your portfolio or in any of the lucky streaks that we might be enjoying at the moment. Number two, consider what unexpected things could happen to your portfolio and make plans for how to deal with any kind of scenario. However, don't just think of unexpected bad events, also think of unexpected positive events. Number three, if you have an opinion about the stock market or anything really that you've based on a few observations of the past, be careful. The past isn't proof. Induction tricks us into believing that the patterns of the past will repeat in the future. They might for a while, but not indefinitely. Certainties are always provisional, so expect the unexpected. Don't let your goose get cooked. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
To watch more videos about making wiser money decisions, click one of these links here.